Last time I was explaining about the tax treatment of sole traders. Well, this week is the turn of limited companies. And here in this video, I'm going to break down the UK tax treatment for limited companies, LLCs as they might be called overseas. And if you run a limited company or you're thinking about starting one, understanding how the tax works is going to be a vital part of your knowledge base, a vital part of your toolkit. Don't worry, by the way, folks, I'm going to try and keep it as simple as possible and throw in some examples as we go through. Now, initially, let's revisit the idea of what a limited company actually is, because it has a bearing on the explanation. Now, a limited company is a separate legal entity, separate from the owners, separate from the shareholders. That means the company itself is responsible for its own finances, debts and taxes. And you as the owner are typically a shareholder and also typically a director, but your personal finances should be kept separate from the company's. So for example, let's take Sarah. She decided to set up Sarah's Creative Studios Limited, wonderful name. Now, the company earns income, pays out expenses, and it's taxed on the company profits it makes. Sarah withdraws a salary, pays herself dividends, and perhaps some benefits in kind on top of that. Now, firstly, let's think about the taxes that the limited company pays itself. There are two main types of taxes a company will potentially pay. One is corporation tax, and that's the tax it makes on its profits. In addition, the company may also pay employers' national insurance contributions on the salary that is paid out to Sarah. That changes in April 25, but for now, let's talk about this idea that there is potential exposure to employers' national insurance. Let's look at each one in detail, and again, I'll do my level best to keep it straightforward and simple. Let's look at the corporation tax initially. Now, corporation tax is charged on the company's profits. Profits are calculated as income minus the allowable expenses. Now, currently, the main headline rate for corporation tax is 25%, where your profits are over £250,000 a year. They're 19% when they go up to £50,000. And if your profits are in between, then you pay what's called full rate, less a marginal rate. And remember, this is for a single company. If you happen to control and own more than one company, the rates will be diluted. Now, let's imagine Sarah's company in a year invoices £120,000 for the work she's done. She's got outgoings on equipment, marketing, her own wages, and the profit then drops to £80,000. That's £40,000 worth of outgoings. Now, since £80,000 falls between the magic 50 and 250, Sarah's company will pay corporation tax at 25% less what's called a marginal rate. The closer your profits are to 50, the bigger the relief. The closer they are to 250, the less the relief will be. Now, let's consider also there might be employers' national insurance contributions. Now, if your company has employees, and that includes yourself, a director taking out salary, then you have a potential exposure to national insurance contributions on top. The current rate is 13.8%, and in April 25 it goes up to 15%. And there's a link in the video, by the way, for a budget update we've got just as for your purposes. Now, Sarah's salary typically is set at a low level to minimise the employer's national insurance and to minimise the tax exposure, and also a very tax efficient number as well. Now, Sarah on a salary of approximately 25 grand a year, for whatever reason, means that she's going to pay national insurance for an employer at around about £1,500 odd. Now, what about this thing called dividends? And for me, dividends are withdrawals that you make from the company for your personal use, which is not in respect of salary entitlement or reimbursed expenses or money you've put into the company. Now, one advantage of running a limited company that has got shares, by the way, not limited by guarantee, is there's more flexibility of how you as the owner are remunerated. Now, dividends, by the way, are personal income. They're not tax-deductible expenses for the company. So again, that's a completely different set of rules, and we're looking at the tax treatment then of individuals. Now, let's assume Sarah's company that's got the £80,000 worth of profits, and she decides to take £20,000 out for a personal dividend. Now, for the year 24-25, the tax rates are as follows. In a personal capacity, the first £1,000 of dividends are tax-free. You get a dividend allowance equivalent to that. Over that figure, up to the higher rate band, 5270, you pay tax on those dividends personally at 8.75%. Anything over that, you're paying 33% approximately, which is a big jump between 8.7 and above that as well. Now, Sarah's total income has been a low salary of about 12 grand, 12,570. The rest in dividends. So she's got an income, personally speaking, of around about 32,500. Now, her total tax bill, doing a bit of number crunching, is going to be in the area of £1,600 odd. Now, there are still filing and deadlines we've got to worry about when it comes to a limited company. Any system of tax always has its deadlines. Now, running a limited company, you need to make sure you keep up with those filing deadlines. The penalties are a little bit more severe. Now, the corporation tax return itself is called a CT600 if you want to bandy that around at parties, is due 12 months after the end of the financial year. The annual accounts typically are due within 9 months of the end of the financial year. Again, if it's late, you'll get a penalty. PAY, National Insurance, typically is accounted for on a monthly basis, albeit you have the option of going for quarterly, depending on the amount of money involved. Let's assume Sarah, in our example, her financial year ended 31st of March 2024. Companies House would expect normally those accounts to be filed by the 31st of December 24. Any corporation tax due has to be paid by that same date, but the actual document, the tax return, doesn't have to be filed until the following 31st of March 2025. Now, good record keeping, just as you were a sole trader, is absolutely vital. Keeping good records, and digital is my advice. For the vast majority of clients, digital is best. Digital makes give you insight as well as keeping your records in nice order. And also, there's the compliance obligation. HMRC will expect you to keep adequate records. Now, folks, there you have it. Hopefully, a nice overview for you to get your heads around. A couple of things just to mention to you. If you are a limited by guarantee, a CIC, the tax obligation does not disappear. And I'm going to deal with that in a separate video. So if you're a company, not necessarily a charity, then tax is still likely to be applying to you. Now, if you're still unsure, not quite sure what's going on, you want to catch up, you want to get some more further advice, drop us a line. If you want to manage your finances more robustly, then check out the notes here for a link to BudgetWiz, our online financial platform, which will do some of the heavy lifting for you when it comes to planning for your future. Until next time, folks, happy filing.